All right, what's up, everybody? Welcome to another Mortgage Coach interview. Today, I'm interviewing Mitch Kider. I have interviewed Mitch many times. I always like to position a lot of these conversations with Mitch is like how to turn compliance into a competitive advantage. Because I think when you do things right and you do the right things, you have a competitive advantage in the marketplace, and you usually deliver an incredible experience in the marketplace. So Mitch, for anyone that's either new to the business or they don't, I don't think there's too many people who have been doing this for a long time that don't know who you are, but you mind just giving a little bit on your practice and who you are in the space?
Sure, sure. So I am the managing partner of a firm that's called Wiener Brodsky Kider PC, with our main office being in Washington, D.C. I started that firm with two other people back in 1992, and we have represented the mortgage banking industry ever since then. Truth of the matter is, I've represented the mortgage banking industry prior to that as well. For 42 years, I have been a lawyer, mostly a troubleshooter for the mortgage banking industry. I do a lot of different things, but I like keeping you out of trouble, or if you get in trouble, I like getting you out of trouble.
Love that. For all you loan officers, this is the guy that is, consulting with your C-suite and leaders of your company on, what are the biggest challenges in compliance. And when they do get in trouble or have issues, he's the one helping you out. So Mitch, with that said, what are some of the biggest topics in compliance right now?
All right, so the biggest topics in compliance, if I had to put them in order for you, I'd probably start with fair lending, and then I would move to RESPA, and then I would move to loan originator compensation. Those are the biggest topics, and some of those topics have hit headlines more recently than others. Let's start with fair lending. Fair lending is the number one priority of this particular administration. It's been the number one priority of a number of different administrations over the years. There are three areas of fair lending that are really, really important today. One is what's known as modern day redlining, and that deals with whether or not you're reaching out and getting applications in underserved census tracts, basically in a majority minority census tracts, not just LMI census tracts, but majority minority. It has to do with whether or not you're lending up to your peers in those areas as a company, and how you're marketing. Do you have the right outreach into these areas? Do you have branches that are in or near these particular census tracts? And are you doing a good job being an equal opportunity lender? Let's put it that way. There's always a lot going on in this particular area. Not only do all of the prudential regulators and the CFPB play a really big role in investigations in this particular arena, but so does the Department of Justice. And the Department of Justice probably has more than 20 cases or investigations pending before it today into redlining against both depository institutions, but against non-depository independent mortgage bankers as well. So that's a very big area, and we are in an election year. Starting January 1st, we'll officially be in an election year, and you can expect to see headlines because a lot of this is political in nature as well. So there's redlining, there's appraisal discrimination. I'm sure you've heard a lot about that. It started off with anecdotal reports about, appraisers going into a home, seeing some indicia that it might be an African-American family that lives in that home and giving a low appraisal, sending other appraisers in without any addition, no family pictures or anything like that, and coming up with much higher appraisals. Appraisal discrimination is a big issue, and it's being pursued pretty vigorously by a number of different agencies, mostly by the Department of Housing and Urban Development, because they are responsible for the Fair Housing Act. And so that's another area. And then the third area that's reasonably new and a little off the wall, if you ask me, beyond pricing itself, because that ultimately you can't have pricing disparities where a group, say African Americans or Hispanics, Latinos, are paying more than another group is paying, but that's pricing in general. But now they're looking beyond that. Even if they find that your pricing is pretty much all right across the board, they're looking at instances of pricing exemptions. So on a proportionate basis, they want to see whether or not a protected minority group under the Fair Housing Act and under ECOA, whether or not they are in fact getting their fair share of pricing exceptions or exemptions that are given mostly, through their loan officer. And that's become a pretty big area for the CFPB, especially looking into that. So that's fair
Well,
lending.
hey, real
Good.
quick before we go off that, because I mean, to me, that one, it I get it. I mean, like there's price exceptions are at an all-time high. I was talking to an executive at Optimal Blue, and they're seeing that the average price exception is like 80 basis points, which
Yeah.
is a lot. I mean, that, 80 basis point equates to a lot in rate. And just I know with the customers that I serve that they're having record amount of price exceptions that have nothing, many of them have nothing to do with discriminatory acts. It's just, hey, rates went down to 2 and 3%. 63% of Americans have a 2 or 3% rate if they own a home, and rates are high. So price exceptions are at a record high. Any suggestions on how to manage that? And
Yeah.
like what are the best practices and the not so best practices?
I'll say a couple of things about that. The first, some people won't really appreciate, but the reality is, I mean, if your pricing exceptions are, as high as on average, let's say 80 basis points, then you're not pricing your loans right. I mean, your company's obviously not pricing the loans to where they need to be priced. But setting that aside, there are best practices to ensure that you don't run into fair lending issues with it. Okay. One is, a lot of pricing exemptions or exceptions take place at the loan officer level. And companies should really have someone else approving an exception. That doesn't just protect the consumer, that protects the company and it protects the individual loan officer as well. So someone else, someone in management, either a branch manager or someone else, should be approving these pricing exceptions. So that's one thing that you have there. Another thing is what the government looks for, what the CFPB especially looks for, is that you document certain things when you're giving a pricing exception. The first thing is they want to know that the consumer asked for it. Because they believe what's happening out there from a discrimination perspective, they believe that what's happening is loan officers are voluntarily telling people you can get a pricing exception or exemption from me, but they're only telling certain people and they're not telling everyone. And they think that is discriminatory in nature. So they want you to document that, in fact, you were asked. You were asked. Someone tried to negotiate with you or asked for a pricing exception. And number two, that your reason for giving a pricing exception is a legitimate reason, such as a competitor down the road is in fact offering them something else. They're offering them a better rate or, better points, fees on the rate or something else along those particular lines. And they want you to document that as well. Doesn't mean you have to tell your LO, go get an LE from another lender, because personally, I think, that's harmful because you're asking them to basically, do business with another lender sometimes when you do that. But it does mean that you have to have some documentation. And it's got to be documentation, I'm a courtroom attorney. And the best documentation that you can have as evidence is contemporaneous documentation, not something that, a month later or 6 months later or a year and a half later, when the CFPB comes and does an examination, you go back and say, oh yeah, this is what happened, so let me write this up. And, if you're going to give an exemption, okay, or an exception, go ahead, okay, and document it. Document that it was requested and document your reasons for doing it. Those are your best practices. The reason why I said what's happening with pricing exceptions is a little off the wall. You're right. I mean, it's off the wall in so many different ways. Number one, there's so many exceptions, and I get it. I can understand that. I can understand, the government's concern about it. And you're absolutely right. Interest rates have gone up, and people are looking for a better rate. Any little bit, basis points, helps along those particular lines. But what the CFPB is doing is they're finding in certain instances that pricing along the board is not disparate. In other words, pricing is fine overall when you look at it. It's just instances of pricing exceptions. Okay. And the reality is, the test under the Fair Housing Act or the test under ECOA really should be, how's pricing look? Am I charging a group? Am I, based on race, ethnicity, or something else along those lines? Am I charging that group more for their loan products than I am, another group? That's problematic. But if overall your pricing is okay, the fact that your numbers may be a little bit off in terms of how many exemptions you do, that shouldn't be a problem. But it is. So you have to look
Well,
at it from
we're
perspective.
finding, and we have a lot of clients that analyze this, and they have found that like MortgageCoach, where a loan officer delivers a total cost analysis versus a fee worksheet, is like up to 65 basis points more profitable. Like the loan officers that are delivering options and strategies, they're giving a lot less price exceptions. So one of the things that we've been, advising our clients is it's time to put more formality around this. And when that exception takes place, not just, it sounds like from a compliance, you just gave me a lot of ammo. Like you need to do this for compliance, but you also need to do this because, for example, if a loan officer instead of negotiates with, say someone else has a 0.5% lower rate, and if you negotiate with an eighth in rate, a quarter in rate, that's a lot of basis points. That's expensive. Whereas if you just negotiated with $500, $1,000, that is more profitable to offer a price, concession versus an interest rate concession. So it sounds like it's both good for sales strategy and it's good for compliance if companies really put formality around what the consumer's getting, how we negotiate that exception, and that we do it consistently. Is that
Yeah,
fair?
you're absolutely right. And your advice is spot on to your mortgage coach community. I will say this, I'll say this about your advice and about Mortgage Coach. I don't know if you remember this, but years ago, I mean many years ago, there were this chain of stores that was called Sims, and they sold suits. They had designer suits in all of them, and they used to advertise all the time on TV. And this guy that, started the company and owned the company, he would come out there in this advertisement and he'd say, an educated consumer is my best consumer, right? And that's the truth. That's the truth in mortgage banking as well. And the reason why you're finding fewer exceptions when you're using Mortgage Coach and you're going through the analysis up front is that very reason, because an educated consumer is actually your best consumer.
Yeah. And it's the most compliant experience out there. And remember, guys, next year is an election year. According to Mitch Kider, that equals more headlines. And I think we all know that's going to be the case. All right. So what's the other that we covered number
Okay,
one?
let's do RESPA and LO comp, and I'll do it pretty quickly for you. So RESPA, RESPA enforcement has been dormant since 2017 until recently. Back in August, there was a consent order that was issued, entered into with Freedom Mortgage and with a real estate company called Realty Connect. And there were a lot of allegations in there. The allegations were that, the mortgage banking company was, loan officers were taking their realtor partners or to a lot of fancy dinners and, spending money on food and wine and things along those lines, giving out tickets to sporting events and charitable events and things, that are like that. And there was an MSA with a realtor called Realty Connect. And part of the MSA had business to business. In other words, there was a payment that was made in order to get into their offices to be able to present yourselves to the real estate agents and do things along those particular lines. So, since the PHH case, since we won that case, and the Court of Appeals for the District of Columbia told the CFPB how to read RESPA and set them back from their revisionist history that they tried to apply. Since that decision, which was sometime in 2017, there weren't any other enforcement actions. People thought that the CFPB kind of left RESPA behind, but they didn't really leave it behind. They're back. And I think that, more than a statement about a company, I don't even think that the consent agreement was a statement about a company. I think it was a message to the industry that said, hey, you got to be careful. There are a lot of bad practices that we see out there that we, the government, thinks are bad practices. And you know what? You can't give people tickets to sporting events in exchange for referrals. You can't do those things because RESPA says, no one shall give and no shall accept a thing of value pursuant to an understanding or agreements that there's going to be business, settlement service business, or business incident to a settlement service referred. RESPA is going to be a very big issue. I can tell you that. The CFPB is conducting in-depth origination exams of lenders. And, there are two things that they're principally looking at in these particular examinations. They look at a lot of things, but they spend a lot of time now on loan originator compensation, and I'll get to that in 1 minute. And they also spend a fair amount of time on RESPA. They want to know about your relationships. They want to know about where the business is coming from. They want to know whether or not you're spending money on these people or giving anything of value in exchange for getting that business. Look, it's an antiquated law. It's a law that's been on the books since 1974. It doesn't take into account what this industry at all looks like today, but it's still there. It's still on the books. And especially in an election year, you are going to see a lot more in terms of enforcement under the Real Estate Settlement Procedures Act. And my fear for a lot of people in this industry is, without any enforcement and really not much guidance at all for the last 6, almost 7 years, okay? A lot of people have forgotten about this and have forgotten about how the prohibition works and how it's been interpreted. And yet that's right there, right now. So that's RESPA.
Just reminder to any loan officer watching this, I'm pretty sure they could give a book, what are the dollar amounts and what are just a reminder on gift giving, what are the do's and don'ts?
Well, so the answer is
It's
there's
the
no
holiday,
yeah, but the answer is there's no minimal amounts.
So it's not an exchange for business. So if you bought 20 books and you gave them to people that give you business and don't give you business, that
Then
is
a
okay.
nice little holiday gift. If you spend money on people that are only giving you business, you have a little problem on your hands.
There you
Okay.
go. Got it. So the guideline is just make sure that, you could get audited and it would, you took care of people, whether they give you business or not the same.
That's right. That's exactly right.
Okay, cool.
And then the third area is LO comp. I got to tell you, I get more questions about loan originator compensation than questions about anything else. I mean, all day long when I'm in the office, the phone is ringing and people are asking about LO comp. It's an unlevel playing field out there. Everyone's got a different understanding of what's required, what's not required, what's prohibited, what's not prohibited. And that's a problem. And now when you look at the CFPB examinations, okay, mostly of, larger lenders, because they want states to look at, smaller lenders. But regardless of who that lender is, when you look at these examinations, they're spending most of their time on loan originator compensation. And this is the first time since 2011 that I've ever seen anything like that. When I tell you that they're taking a deep dive, they're taking a deep dive. They're looking at everything, every record you have, every policy you have, anything you've ever done, and every method of compensation that you otherwise have across the board. They're looking at your business practices as it pertains to that particular compensation. And you got to be careful. You've got to be careful about it because, you can't get compensated as an LO based on the terms of a loan. Okay. You can't get compensated, for anything that's a proxy for the terms of the loan. So that's anything that you, the loan officer, has control over. You can't steer them into a loan in which you're going to get paid more because that would be violation of the LO comp rule. And LO comp, it's been a problematic rule since the Fed first enacted it in 2011, and then the CFPB took it over and updated that regulation in 2014. And one of the specific things in this particular rule is that you can, as a loan originator, you can get paid, okay, one way for self-sourced loans. You're out there, you're pounding the pavement, you're finding your own business, you're doing that, you're going through the cost and expense of doing that and the work of getting your own. And so let's say you get paid, 100 basis points, just to pick a number out of the blue for that. And your lender, your employer, can pay you differently for loans that were sourced by the lender. In other words, loans that, where the lead comes from the lender, and they give you that, and you can have a different compensation rate along those lines. And that is all perfectly legal under the LO comp rule. The problem that we're seeing out there is sometimes with loan officer compensation and with margin compression, a loan officer can't make that particular loan based on their rate of pay. And so what do some loan officers do? They move it. They say, well, you know what? I'm just going to treat that as a lead that was generated by the lender. And I'm here to tell you that's a problematic practice, and you've got to watch out for that. So,
Got it. Well, I want to hit some topics that have been coming up in my world and in mortgage and real estate. Right now the lawsuits coming down on the real estate industry and the future reform on selling agent, buying agent. Any leadership you have, any thoughts you have on, is change happening? When is change happening? Anything that you think would be valuable to lenders and loan officers here?
So these commission lawsuits, they came down pretty quickly, and settlements happened really quickly, and then you had a trial. Things are moving very quickly along those particular lines. And the reality is the movement is putting, what is a buyer's agent, a buyer's real estate agent, in danger. And that's the reality of it. Because today, most consumers go on the internet to find the house that they want. And if they don't find the exact house, they find the community that they want. And what's the next thing they do after that? They call an agent. They ask their friend or they know an agent, and they call a buyer's agent. And they do that without thinking about it because it's at no cost to them. At least in their mind, it's at no cost to them. Because, the contracts that are being found to be in violation of our antitrust laws basically say you want to be listed on the MLS, okay, you're paying your listing agent, and as a seller, you're paying the buying agents as well. Well, that's getting thrown out. So in the future, what's going to happen is I'm going to go online, I'm going to find my house, and I'm going to go call a buyer's agent, and I'm going to say, hey, can you help me out? Take me to see this, and let me see some similar houses and stuff. And the answer that you're going to get back is, yeah, I'd be happy to do that, but I want you to know it's going to cost you, right? And that's a little different. And it's certainly not going to cost you 3 points, okay? That's not going to happen. It's not going to be 3 points. It's going to be considerably less if that happens at all. So what do I think is happening? I think this is important for the industry, and I think it's really important for loan officers to understand what I think is going to happen. And everyone's got their own opinion about this. I actually think it's going to happen quicker than most people think it is. And that is, number one, the relationships that are really important are going to be at the listing level. Okay. That's where they're going to be. It's going to be with the listing agent and less so with the buying agents. That is something that I think is going to happen. And number two, I think there are other opportunities that are available for lenders as a result of that. So let me explain that a little bit. I don't think in the long run that buyer agents are going to survive, at least not the way they are. Okay, because the economics is going to change on them dramatically, and people aren't going to want to pay for that particular service. So I think you're going to find consumers calling up listing agents more and looking to listing agents for assistance along those particular lines. I also think that there are others that can fill the role, some of the role that a buyer's agent does. I think buyer agents are really important. The consumer needs to be protected, and they need to have an agent on their own side. But I'm not sure that the consumer is going to be willing to recognize that and want to pay for it. I think you're probably going to see some cottage industries where attorneys or others step in and say, hey, if you're buying a house, let me walk you through the process and let me represent you in this. In New York, the rule is if you're selling your home and if you're buying a home, you need to get your own attorney, because they'll tell you there are no form contracts out there. They pretend to negotiate with each other, so they can each get their, $700 or whatever it is that they get paid on it, although most contracts come out looking the same at the end of the day. But I think things like that are going to spread, across the nation. And I think you're going to see some entrepreneurial people, accounting types and lawyer types that are going to hold themselves out to play a big part of the role that a buyer's agent has been doing. I think that the listing agent's going to hold themselves out a lot more as being point of contact. So from a loan originator for a retail, okay, let's talk about a distributed retail loan originator. Your contacts today, and probably your most important relationships today, are with buyer agents. And that's going to change. That's going to change. I think it'll change quicker, but regardless, change immediately or change slowly. I don't think it's going to be immediate, but I think in the next couple of years, we come back and revisit this issue 2 years from now, it's going to look very different. That's what I think is going to happen. And so you have to start thinking about building those relationships elsewhere as well.
Yeah. So by 2026, change will have happened. It will look different, and there's chaos and there's opportunities. You think, and I'm with you, attorneys, some type of entrepreneurial opportunity with people that are good process managers to help that consumer go through the process of finding the right home, negotiating the right home, and protecting themselves in the acquisition of that home. What are the what are
But
your
add one thing to that. Let me just add one thing to that, because I think it's important. There are also opportunities for mortgage companies and their LOs, because for a long time, okay, this industry has been knocking on the door of being the first point of contact,
right?
and in many ways, after a consumer sees something online and says, wow, I think that's the house that I want or something else, it makes more sense, to tell you the truth, to go to a lender first. Because you go to a lender, you get pre-qualified, you get pre-approved, you know what you can afford along those lines. And I think that with some effort, either on an LO level or the company level or both, okay, I think lenders are going to step in to that first point of contact role even more so, and so I think there's opportunity. So when I tell you that there's opportunity there, that's the opportunity that I think exists. And I think people need to start thinking about that now.
Oh, absolutely. Well, first of all, one of the things we're advising everyone in our community, who are the realtors that were successful a year and 2 years ago are not necessarily the same realtors that are successful today. Make sure, and there's lots of technology where you can look and know what production realtors are doing. Make sure you're doing business with people that are doing business today. And then to Mitch's point, start thinking about who's going to be doing business tomorrow and prioritizing those folks. And then you did say something where I was going to go with it is I do think there's an opportunity for lenders to get in this space. And I personally would be surprised if some of the biggest companies don't form a buyer concierge, won't be called a buyer's agent, but a buyer concierge program, which will, have some type of an agreement that is signed. It will have services that are assigned, and they'll make money. It will be a for-profit venture,
I
right?
can tell you, lenders are already starting to think about that. That's exactly right.
Yeah. So that's I got two more questions, but that segues into my next one, which and there's been many times where I've interviewed you and we've spent the whole time talking about joint ventures, MSAs, and compliant relationships between lenders and realtors. But with what's happening, it sounds like it's pretty obvious that there's going to be even more collaboration in partnership
Oh, yeah.
between mortgage and real estate. Like we're all in housing. And so any do's and don'ts around that? Any trends that you see around, and I'm sure we could spend hours on this, but any high level things on MSAs and
So the trends that I see, mostly around joint ventures. I'll get to MSAs in a minute, but let's take a look at joint ventures. I think joint ventures, on average, are better capitalized than they used to be. They're not de minimisly capitalized anymore. And an interesting trend that I'm seeing in joint ventures are joint ventures that are not simply with a brokerage company, for example, but with some agents that have an ownership interest as well. Because the reality is, real estate brokers have always had a really hard time, capturing the mortgage side of the business. It's not the same as a home builder. A home builder, can capture that side of the business. But real estate side, there are so many other people that are competing and providing advice and guidance and telling the consumer where to go. And the reality is, real estate agents are independent contractors. So you're the brokerage company that you're hanging your license at may say, hey, I have this affiliated joint venture. I want you to send your business there. But you say, you know what? I have my best friend that lives next door to me, and they happen to be a realtor, and they give me great service, and that's where my business is going. And that's what's been happening. But I think that joint ventures in that area, I see more of them than I did before. People were shying away from these JVs with real estate companies because of the lack of a capture rate. But now I'm seeing more of that, and I see people trying hard. They're thinking hard about, okay, what else can we do to capture that business? And sometimes that means having some of these independent agents as part of that. Now, you have to be careful. You can't say you can have an ownership interest as long as you stay with this brokerage company, and then when you leave, I'm taking it away, because they're going to tell you that ownership interest was a sham. So you have to think through the consequences and the implications of doing something like this. But there are a lot of joint ventures that are going up right now in the insurance business. Okay, with insurers that provide hazard insurance, things of that sort, which is a settlement service, on a purchase mortgage, right? And the ones that are most successful, don't just have a JV with the mortgage company or the owners of the mortgage company, but they have it with some of the best LOs that are in there too, that the mortgage company brings in and allows them to buy a piece of that. So they have the incentive there. Now you've got to jump through the right hoops. You've got to, you got to structure it correctly. You got to give affiliated business, disclosures. You can't get anything more out of it than a return on your ownership interest. But that's the biggest trend that I see. And there's a lot of joint ventures that are going up today in those areas. MSAs, the truth is, they're still out there, but fewer and fewer people are asking about MSAs. And I think that's because it's so unclear, the guidance that we've gotten over the years from the government, that people are looking for, sounder grounds to stand on. Not that you can't do an MSA, but remember, if you do an MSA with another settlement service provider like a realtor, you know, the marketing that they do for you has to be real, and it's got to go to the general public. It can't be just marketing to their own consumers. And you can't judge your MSA based on your capture rate, because your marketing should be going to the general public. So that's what's going on in that arena.
Oh, man, it's always a good time talking to you, brother. I want to close out with just questions on trigger alerts. This is something we track closely at Trust Engine. Our thoughts on it is, of all the different data signals that lenders can use to retain customers and to anticipate the needs of a consumer, it's the least predictive. It's like, you're late. They've already ran a credit report with someone else. Best case, you're the second person there. In most cases, you're probably number 20. Like they are noise for consumers. And so we believe in just being predictive and being valuable, and they're not. So what are your thoughts on, are they going away? When are they going away?
Well,
Any thoughts on that type of a data signal?
so trigger leads being, a lead that, you go to the credit reporting agency and you tell them, you give them your specifications, and you tell them you want them to tell you when a consumer that meets those requirements has had a credit inquiry from another lender. That's your typical trigger lead. And, it drives consumers crazy, because as soon as they apply for a loan, they get 20, 30 looks at their credit report and things along those particular lines. And I think it drives the government crazy and regulators crazy as well. And you're telling me it's not very effective, and I can appreciate that. Yeah, there's
Well,
going to be
time out. It is effective, but there's more effective. There's much higher ROI strategies.
Sure, I got you. And that's a good thing that there's much higher ROI strategies, because there will be legislation. Okay, there are 3 bills right now. There are 2 that were introduced in the House. The first bill was introduced that would have an absolute ban on any type of, looking for a lead by way of credit reporting. Just say no, you can't do it, period. There's one that was introduced in the Senate, and the Senate says, because you have to give, when you get a credit lead, you have to give them a firm offer of credit. So the first piece of legislation that's pending would just wipe all of that out. The second piece is in the Senate. The second bill that was introduced in the Senate, and that says, you know what, you can't do these credit trigger leads. Even if you're going to give them a firm offer of credit, unless you have the consumer's consent, their affirmative consent to allow you to do that. Well, that doesn't work. You're going to go right to, thousands of consumers and say, give me your consent. So that's a problem. The third one is probably what the law is going to end up being at the end of the day. And that also was introduced in the House. It's been referred to committee, but it hasn't gone any further, as best I can tell, yet, which means, you're talking about reintroducing these things next year. But the third one is, you can do these credit leads if one of 2 things are there. Number one, you have consent from the consumer, which isn't very practical in all honesty. Or number 2, you have an ongoing relationship with that consumer. And that's put out there, I think, to protect servicers, right? So servicer would be able, because they have that ongoing relationship, to look for credit leads, because they may find that someone in their portfolio wants to refinance and they want that opportunity to keep that, right? So they want to go ahead and refinance it. That's a bill that's strongly endorsed by the Mortgage Bankers Association and a number of other associations. I actually think that at the end of the day, you will see legislation pass next year that will address this particular issue, because there's a bipartisan consensus that this issue has to be addressed. And so I think it will be, and I think it will probably end up being along the lines of what I just described, and that is, yeah, you can still do credit leads, but only if you have consent, or you have that ongoing relationship. Not that you did a loan for them in the past, but an ongoing relationship that gives you reason to look for that. So that's what I think is
Yeah,
going to
we
happen.
yeah, we have been consulted with by the NBA, and we do think, legislation is appropriate for that type of lead. The only thing that we recommended so far, it doesn't look like it's gotten traction, is that both the servicing lender who has the ongoing relationship, to me that's obvious that they would have a carve out, and that the originating lender, that may not have the servicing but did originate the loan.
Right.
The one thought I see coming, just where the puck is coming, is for lenders to start thinking about having a more clear permission-based relationship with people. I mean, I think Kristen and I started First Home IQ, and part of the thesis of that is that the mortgage industry can become the first responders to the financial literacy crisis in America. And if we have a more intentional relationship with people, where we're providing services beyond the transaction, like helping them make the best decisions, understanding that, gathering data and anticipating their needs so that we could give great advice. But, and I do think being a buyer's agent, like, I would be looking at like, hey, this is the services we have, and getting some type of agreement and permission from people to monitor their credit and optimize their finances for life. Like, I can see those type of agreements happening. Do you agree with that?
I do agree with that. I actually think the future of this industry lies in what happens after you originate that particular loan and the lifelong relationship that you otherwise have. I think it's going to take time to get consumers, comfortable with giving permission to monitor their credit and do things along those particular lines, as long as they understand that that's what you're asking for. Because, people are worried about their credit. They read about data breaches all the time. They're worried about, what impact people looking at their credit is going to have on their credit rating, and their credit score and things of that sort. I think it's going to take some time to get to that point where you get that permission, where you get it consistently, in numbers that make a big difference. But I do think that's the direction that it should be headed in. And I do think that the future of mortgage banking really does lie in what happens after you originate that loan. I do.
Yeah, no, I agree. I don't think it needs to take time. I think it needs to be, for any lender listed as loan officer, you need to bring value, beyond the transaction, advice. You need to bring transparency, like, this is what we're doing, this is how we're doing it. But if you educate, to your point, like, hey, when I take your loan, I provide you with options. I show you strategies to pay off your debt faster. I'm showing transparency beyond the normal experience. And hey, I'm going to continue to monitor your mortgage and give you strategies to pay off your home faster, to achieve financial freedom faster. Like, if we as an industry really get behind this movement of financial freedom lending, um, I think consumers will sign up. It just has to be well executed, and
It, it's an educational process. That's the only reason why I
well,
say
it does take time, to your point.
it's an educational process. That's
Yeah.
what it is. Yeah.
Well, Mitch Kider, super grateful for you. I know, for anyone that wants to, learn more about your services, what's your website, any place that they should follow you on social media to stay connected, anything?
You can follow me on LinkedIn at Mitch Kider. You can follow me on, I guess, what's called X at Mitch Kider. You can look at our website. It's thewbkfirm.com, or you can just call. Just give me a call. The number's 202-557-3511. Happy to talk to anyone.
Well, I am grateful for the time we spent here, all the wisdom. Appreciate you, my brother. And let's do this again early next year.
Sounds good, man. It's good to see you. Thank you.
All right. Take care, man.